Imagine you are standing on the observation deck of the Burj Khalifa on a warm evening in early 2025. The city below you is spectacular in the way that almost defies belief. Towers of glass and steel stretch in every direction, each one seemingly competing with the next to be taller, more elaborate, more impossible. Construction cranes dot the skyline by the dozens. Somewhere below, a broker is closing another deal. Another floor of apartments is going up in Jumeirah Village Circle. Another off-plan project is being launched with artist renderings of pools and rooftop gardens and community-centric living. And on your phone, a property portal is telling you that prices are up. Again, they have been up for 15 consecutive quarters. The numbers from the Dubai Land Department are staggering, as in every headline repeats them with pride. 270,000 transactions in 2025 alone, worth 917 billion dirhams, which converts to roughly $250 billion. A city building itself in real time, fueled by the world's money going vertical while the rest of the world watches. That is the official story of Dubai real estate. It is compelling, it is backed by real numbers, and it is, in important and specific ways, incomplete. Because there is another set of numbers. Numbers that the developer brochures do not feature. Numbers that explain why Fitch Ratings, one of the world's most conservative and methodologically rigorous credit analysis firms, issued a correction forecast for this exact market. Numbers that explain why the UBS Global Real Estate Bubble Index, which ranks cities by the fragility of their property markets, has placed Dubai in its elevated risk category. Numbers about supply waves and salary stagnation, and a class of asset that now makes up nearly two-thirds of all transactions in Dubai, but that carries a specific and historically familiar kind of risk. This video is about those numbers, not to declare that everything is collapsing because it is not, but to ask the question that the brochures will never ask: what is this market actually built on, and who gets hurt when the math stops working? Let's establish what Dubai was selling, because understanding the product is essential to understanding the risk. The pitch was elegant and it worked on millions of people across dozens of countries. No income tax, ever. Rental yields between 6 and 9%. Hit at a time when London was offering 2 and New York was barely cracking 3. A population growing fast enough to sustain demand indefinitely. A government with the resources and the will to build infrastructure faster than almost any city in history. And above all, a safe haven. Political stability in a region of instability. Rule of law in a neighborhood where rule of law was not always guaranteed. In the chaos years after 2011, when the Arab Spring rewrote the map of North Africa and the Levant, global capital flowed into Dubai precisely because it was the one address in the region that felt permanent. That was the real product, not the pools and the rooftop gardens, not the tax efficiency. Dubai was selling certainty. And certainty, when it is scarce, commands a premium. The pitch landed. It landed with Indian investors who snapped up 1 in every 5 properties sold in the city, accounting for 20 to 22% of all transactions, according to broker data from early 2026. It landed with Russian capital that accelerated its flight to Dubai following 2022. It landed with European professionals tired of cold weather and high tax rates. It landed with Gulf Cooperation Council money looking for a domestic safe harbor. The population surpassed 4 million in 2025, a year ahead of the city's own projections. Private school enrollment climbed 18% in 3 years. New business licenses hit nearly 50,000 in a single year. These are not fabricated numbers. The demand was real, the migration was real, the construction was meeting something genuine. And then someone started counting the cranes. Here's where the data gets uncomfortable. As of 2025, approximately 365,000 residential units were sitting in Dubai's development pipeline. That is not units already built. That is units sold, under construction, or in advanced planning, scheduled for delivery between now and 2029. To understand the scale of what that means, consider this. The peak delivery year is 2026, when an estimated 117,000 new units are expected to reach handover. In the 3 years prior to that, The entire city was delivering roughly 36,000 units per year, according to the historical completion rate tracked by analysts at Place Overseas. So, in a single year, the market is being asked to absorb more than 3 times its average annual supply. The Cavendish Maxwell research firm, in their own measured language, warned that this clustering of deliveries could create what they called pockets of absorption pressure, particularly in districts where several phases are delivered simultaneously. That is real estate research language. Translated into plain English, there will be neighborhoods where nobody can sell. Fitch Ratings was less circumspect. Their official projection, issued in 2024, was that Dubai residential prices face a correction of up to 15% in the second half of 2025 and into 2026, following a run-up of 60% in prices since 2022. 60% in 3 years. That is not a gradual appreciation. That is a vertical trajectory. And Fitch, it should be noted, is not a fringe voice. They are the institution that rates sovereign debt. When they say correction, and the people who move billions of dollars listen. The UBS Global Real Estate Bubble Index 2025 assigned Dubai a score of 1.09, placing it in elevated risk territory alongside Miami and Tokyo. The index flagged specifically that prices had begun outpacing rents for the first time since 2021, that incomes were lagging property values and straining affordability, and that speculative off-plan demand had intensified to the point where it deserved explicit monitoring. That last point deserves its own paragraph. In 2023, off-plan properties accounted for 54% of all Dubai real estate sales. In 2024, that number climbed to 63%, according to data compiled by Engel and Volkers Middle East and independently confirmed by Property Finders MarketWatch. By the third quarter of 2025, off-plan was accounting for 76% of all transactions. 3 out of every 4 properties sold in Dubai in the peak of 2025 had not yet been built. Analysts at Place Overseas called this a classic sign of a speculative cycle in real estate markets. The Financial Times noted that property flipping had at one point accounted for roughly a third of all resales in the city, meaning buyers were purchasing units not to live in them or even rent them, but to sell them to the next buyer before the keys were ever cut. That pattern has a name in financial markets. It is called the greater fool theory. It works perfectly until it does not. Now let's talk about the other side of that equation, because a supply wave only creates a crisis if demand is not there to meet it. And this is where the affordability data enters the picture and where the story gets genuinely complicated. Dubai is now the most expensive city in the Middle East for expatriates. Mercer's cost of living city ranking, released in June 2025, placed Dubai 15th globally, up 3 positions from the previous year. A one-bedroom apartment in a central location averages 8,700 dirhams per month, which is approximately $2,369 every month, or $28,000 per year, just for a one-bedroom. A 3-bedroom in the center runs 16,500 dirhams monthly, equivalent to roughly $4,500 or $54,000 a year. And those numbers are before groceries, before school fees that can reach 150,000 dirhams annually, i.e. before mandatory private health insurance, before the car that is essentially non-optional in many parts of the city. Against those costs, Cooper Fitch, one of Dubai's leading recruitment consultancies, surveyed more than 1,000 organizations across the Gulf region for their 2024 salary. They found that companies in the United Arab Emirates were, on average, budgeting for 0% salary increases. Not 2%, not inflation-adjusted flat, 0. The actual number, an expected average salary increase of 0% for 2025, despite projected gross domestic product. The Halion recruitment firm's own 2025 Gulf Cooperation Council market report found that while 40% of professionals did receive increases, those ranged from 5 to 10%. As Halion Chief Executive Officer Stuart Fry said directly, these increments are often not enough to keep up with the rising cost of living in the United Arab Emirates, particularly in areas like housing and education. The managing director for emerging and frontier markets equity strategy at the global data firm Telemaire, Hasnain Malik, framed the systemic risk in one precise sentence. So many factors are in Dubai's favor, but deteriorating affordability is a risk for medium-term population growth. When the people earning the salaries can no longer afford the rents, the renters leave. When the renters leave, the landlords drop prices. When the landlords drop prices, the investors who bought at peak reassess. This is not speculation. This is arithmetic. Now let's talk about what a supply wave actually looks like when it lands, because Dubai has been here before. In 2006 and 2007, the city was in a frenzy that looked, from the outside, very much like the current moment. Off-plan properties dominated sales. Developers were launching with revolving skyscrapers and kilometer-high towers in their artist renderings. Capital was flowing in from every direction. Then the global financial crisis hit in 2008. Credit froze worldwide, and what happened in Dubai is now in textbooks. Property prices fell by as much as 50 to 60%. Not across a decade, across months. The Wikipedia entry on the 2009 Dubai housing crash records that prices in some areas fell 40% in the first 3 months of 2009 alone, the fastest decline anywhere in the world at that moment. Towers sat half-built. Developers defaulted. The government had to intervene with direct financial support to prevent a cascade of institutional failures. The honest defenders of the current market are quick to point out that 2026 is structurally different from 2008, and they are correct in specific, important ways. The Dubai Real Estate Regulatory Authority has implemented escrow requirements that protect buyer deposits if developers fail. Mortgage caps limit the degree of leverage in the system. Cash buyers, by multiple estimates, represent between 60 and 87% of current transactions, meaning the forced selling spiral that drove 2009 is less mechanically possible today. The population is 4 times what it was during that crash. End-user demand, buyers who intend to actually live in what they purchase, has a larger share of the market than it was in the pure speculative boom years. These are legitimate distinctions. But here is what does not change between 2008 and now. The basic relationship between supply, demand, and price. 365,000 units in the pipeline. A population that needs roughly 50,000 new homes per year based on household formation rates. That gap does not close on its own. It closes through price discovery. And price discovery, when supply exceeds demand, only moves in one direction. The impact of what is coming is not uniform, and this is the part of the analysis that matters most for real people making real decisions. For the ultra-wealthy, the Dubai market correction is largely an abstraction. If you hold $20 million in a family office in the Dubai International Financial Center, the difference between a 2026 peak price and a potential 15% correction is a rounding error on your portfolio. And the zero income tax environment still represents a structural advantage that no correction changes. The prime waterfront villas on Palm Jumeirah and Jumeirah Bay Island, the truly scarce land-constrained product, will likely outperform the market correction by a significant margin because their supply is genuinely finite. Fitch and Knight Frank both project the luxury segment at the top will be more resilient. For that cohort, this story is noise. For the professional expat middle class, which is the engine of Dubai's economy and the demographic that the city needs most to retain, the calculation is entirely different. This is the financial analyst earning 18,000 dirhams a month, the engineer at 30,000, the marketing director at 25. These are people whose salaries are flat, whose rent has just gone up 16% according to the CBRE head of Middle East and North Africa research, Matthew Green's data for 2024, and who are now watching 117,000 new units approach handover in 2026, wondering whether to wait and let prices correct or commit now at what could be the top. If they bought off-plan at peak prices in 2024 or 2025, and they are now approaching handover into a softening market, they face a gap between what they owe and what the property is actually worth at delivery. That gap is not hypothetical. It is the defining risk of the current market for the broad middle of buyers. For the migrant worker, the construction laborer, the hotel housekeeper, the delivery driver, the category of person who built this city and continues to service it daily, the affordability crisis is not a calculation. It is a lived experience. Average salaries below 8,000 dirhams a month, which converts to roughly $2,175 in a city where a one-bedroom apartment alone costs that much each month, means shared accommodation in distant neighborhoods, long commutes, and the slow arithmetic of money sent home becoming money that does not stretch. The supply wave of new luxury apartments has no practical bearing on the life of a South Asian construction worker earning 4,000 dirhams a month. But the city cannot function without those workers. And as the affordability pressure reaches down through income strata, the question of whether Dubai can sustain the labor base that keeps it operational is not abstract. It is a question about the physical delivery of the city's daily life. Here is the part that institutional boosterism does not want you to sit with. The vulnerabilities that are now testing the Dubai real estate market did not arrive suddenly. They were built into the structure of the boom years and are the predictable result of decisions made when the numbers were excellent and the incentives were all pointing in one direction. The first structural vulnerability is the concentration of supply in a narrow product category. Of the approximately 302,000 units scheduled for delivery between 2025 and 2029, almost 80% are apartments. Not villas, not townhouses, apartments, and not apartments across a spread of price points. The pipeline skews heavily toward the mid-range and upmarket segments, precisely the area where affordability is most strained and where the incoming supply wave will create the most competitive pressure simultaneously. Jumeirah Village Circle alone, which is a high-density apartment community, is scheduled to receive multiple simultaneous project completions that Cavendish Maxwell flagged directly as a zone of absorption risk. The second structural vulnerability is what analysts at Place Overseas called the inflation-adjusted reality that the official numbers obscure. Nominal prices in Dubai are up 60% since 2022, and headlines repeat this as evidence of health. But when you adjust for cumulative United States inflation, which stood at 36% between 2014 and 2025, the real gains in the Dubai market look considerably more moderate. This matters because a significant portion of Dubai's investor base holds assets in dollars, euros, or British pounds. Their real return calculation includes currency movements and inflation in their home economies. When you strip the nominal shine off the Dubai number, what remains is less dramatic than the headline suggests, and the risk-adjusted case for buying at current prices is correspondingly weaker for a careful international investor. The third vulnerability is the off-plan payment plan structure itself, which has been celebrated as an innovation that democratized access to the market. Many developers are offering payment plans that stretch to 2028, 2029, even 2030, with small initial deposits and installments spread across the construction period. This sounds investor-friendly, but what it actually does is defer the moment of price discovery. The investor who bought at a 2024 or 2025 price with a 2029 handover does not feel the market correction immediately. They feel it when the building is finished and they are trying to either rent the unit or sell it, in a market where hundreds of thousands of similar units have arrived simultaneously. The Financial Times documented that flipping, which is the practice of selling an off-plan contract before handover, accounted for a third of resale activity at one point. As market conditions tightened, that number dropped to around 20%, according to the same reporting, because more investors were struggling to exit their positions. When the exit route narrows, what looked like a liquid asset reveals its illiquidity. The fourth vulnerability is the one that gets the least attention because it requires the most uncomfortable admission. Dubai's boom has been partially fueled by a category of capital that is specifically geopolitically contingent. The Russian wealth that accelerated into Dubai following 2022 was flight capital, money leaving a jurisdiction due to political risk and looking for a jurisdiction with none. The Gulf Cooperation Council money that flows in and out is sensitive to oil revenues, which are themselves sensitive to global energy markets and the broader trajectory of the energy transition. The Indian investor community, which accounts for a fifth of all transactions, makes its decisions partly based on the trajectory of the Indian rupee against the dirham and partly based on domestic Indian investment alternatives. None of these capital flows are permanent. All of them are conditional. A market that has absorbed record volumes of transaction activity driven by capital that is, by definition, mobile and reactive to external conditions is not the same as a market driven by demographics and domestic wage growth. When sentiment shifts, mobile capital moves. It does not warn you first. What happens next depends on several variables that nobody can predict with precision. And any analysis that claims certainty in either direction is selling something. But what the data does allow is a mapping of probabilities. The most likely scenario, which aligns with the projections of Knight Frank, Cushman, and Wakefield Core and Better Homes, among others, is a moderate and segmented correction. Knight Frank's Faisal Durrani, partner and head of research for the Middle East and North Africa, projected price rises of around 3% in the prime segment and roughly 1% in the mainstream market by the end of 2026. That is not a crash. That is deceleration. Cushman and Wakefield Core forecast mid-single-digit appreciation of 5 to 8%, a significant slowdown from the 15 to 19% annual gains recorded in 2024. The correction, if it materializes, is most likely to hit the mid-range apartment clusters, the high-density neighborhoods with simultaneous mass handovers, and the off-plan positions purchased at 2024 and 2025 peak prices by investors who are now trying to exit into a market where supply has caught up with them. The luxury end and the established communities with genuine scarcity of land are likely to hold better. The geography of pain, when it arrives, will not be uniform. The operational recovery from any correction will be relatively fast. Dubai has demonstrated this repeatedly. The population decline of 2020 was followed by record numbers by 2022. The 50 to 60% crash of 2009 was followed by a recovery that eventually drove prices beyond their pre-crash levels. The city's physical and institutional infrastructure is genuinely excellent. The regulatory environment, despite its limitations, is materially more mature than it was in 2008. The government has both the financial resources and the political will to intervene if the correction threatens systemic stability. None of that is in question. What takes longer and what the data does not yet answer is whether the affordability compression has already done structural damage to the mid-income professional cohort that Dubai needs to retain. That cohort does not leave dramatically, it leaves incrementally. An accountant from Mumbai takes a job in Singapore instead. A digital marketer from London decides Abu Dhabi's cost structure makes more sense this year. A project manager from Egypt realizes that Riyadh is offering packages that Dubai used to offer. The city feels these departures in aggregate, not individually. And by the time the aggregate becomes visible in the data, the trend has already been underway for years. If you are sitting with your own Dubai calculation right now, whether you own property here, are thinking about buying, or are an expat weighing whether to renew your life in this city for another 3 years, the question that matters is not whether Dubai is going to crash tomorrow. It is probably not. The question is whether the conditions that made Dubai exceptional are still exceptional, or whether the city has moved from being the arbitrage opportunity of the decade to being simply another expensive global city with significant new supply coming online at a moment of compressed affordability. Those are two very different value propositions. Only you can run that math for your own situation. Has your calculation changed? Are you watching this from inside the market or from the outside looking in? The comment section is where this conversation gets interesting, and it is where the most useful information in any of these videos actually lives. And if this kind of deep structural analysis of what is actually happening in the world's most watched real estate markets is what you came here for, then you already know what to do next.